Dear students, welcome to the third session on the chapter Valuation of Shares. Here in this session, let us solve two more questions under intrinsic value method of valuation of shares. Following is the balance sheet of A Company Limited as on 31st 12 2012. On the asset side, they have given sundry assets 5,10,000, discount on issue of shares 10,000, preliminary expenses 90,000. On the liability side, 10,000 6% preference shares of rupees 10 each 1 lakh, 30,000 equity shares of rupees 10 each 3 lakh, general reserve 20,000, depreciation fund 10,000, 7% debentures 50,000, debenture redemption fund 30,000, creditors 1 lakh, contingent liability rupees 650 in respect of compensation payable to workmen. In the paragraph, it is given that the preference shares are preferential as to the capital and the arrears of preference dividend are not payable on liquidation. Assets in the balance sheet are worth their effective book values. There is an asset worth rupees 1,500 not recorded in the books of accounts. Okay, the dividend on preference shares are in arrears for 2 years. Calculate the intrinsic value of shares. So this is the first question. As we discussed in the previous session, here the intrinsic value will be calculated under two steps. In the first step, we are going to calculate what is the net asset available for equity shareholders, and then in the second step we calculate the intrinsic value by applying the formula intrinsic value is equal to net asset available for equity shareholders divided by number of equity shares. So now in the first step we are going to calculate net asset available for equity shareholders. As we discussed in the previous session, when we calculate the net asset available for equity shareholders, first we need to write the present values of various realizable assets. Okay, from that we are going to deduct the external liabilities, and then whatever the balance remains, that is considered as net asset available for all types of shareholders. Then we are going to deduct the amount payable to the preference shareholders, and the remaining balance is called net asset available for equity shareholders. Now let us find out what are the various assets you have to write at their present market value. Coming to the asset side, they have given sundry assets. Okay, how much is the book value given here? 5,10,000. In the paragraph, it is given that assets in the balance sheet, sundry assets which is given in the balance sheet, are worth their effective book values. Okay, so whatever the book value given in the question, that itself is the present value. But if you check the liability side, there is a depreciation fund created against this asset amounting to 10,000. As we are considering here book value, if there is any depreciation fund, that should be deducted. On the other hand, if we consider the present value given in the question, then the present value will be after considering all the appreciation and depreciation. From the present value, we are not deducting the depreciation, but in this case, as we are considering the book value, we have to deduct this depreciation fund amounting to 10,000. Okay, that is the first adjustment. Then they have given the second asset, that is discount on issue of shares. It is not a realizable asset, it is fictitious asset. Then preliminary expenses they have given, again it is not a fictitious, it is not a realizable asset, it is fictitious asset. So here in the books we see only one asset, that is sundry assets. Then here it is given that there is an asset worth rupees 1,500 not recorded in the book. So there is an unrecorded asset which is not yet shown in the books of account. But here we are going to calculate the value of shares on the basis of, or on the assumption that the company is going into liquidation. If at all the company goes into liquidation, even they will realize this unrecorded asset. So you have to consider this as well. Okay, let's see how to write these assets in the format. So in the first step, calculation of net asset available for equity shareholders, first we will be writing the sundry assets 5,10,000. From that we are deducting the depreciation fund 10,000. We will have 5 lakh. From again we are going to record one more asset, that is unrecorded asset amounting to 1,500. We get the total of 5 lakh 1,500, which is called gross market value of various assets. From this we are going to deduct the various external liabilities. On the liability side, first they have given preference share capital, it is not a liability. Equity share capital, not a liability. General reserve, not a liability. Depreciation fund is with regard to sundry asset, which is adjusted. Then 7% debentures, yes, it is a liability. Then debenture redemption fund, it is not a liability, it is a fund, or it is a reserve which is created out of accumulation of profit. Okay, Then creditors is a liability. There is one more liability, contingent liability, rupees 650 in respect of compensation payable to workmen. So here in the amount column you see nil because it is not an actual liability, it is contingent liability, which means such liability may arise or it may not arise in the future. But here we are calculating the value share on the basis of company going into liquidation. So if at all the company goes into liquidation, they have to pay towards this liability also. So they have to provide for that. So we are considering this also while calculating the net asset available for equity shareholders. Okay. So in the format under the external liabilities, we are going to write three liabilities. First one is debentures, which is a secured liability, then creditors and contingent liability. When we deduct these external liabilities from the gross market value of various assets, we get a balance of 3,50,850. So this is called net asset available for all types of shareholders because in this case we have preference share capital. After this, we are going to deduct the amount payable to the preference shareholders. Here, when I say amount payable to the preference shareholders, there will be normally two items. The first one is their capital and the second one is arrears of preference dividend. So let's see what is their capital. Here we find 10,006% preference shares of rupees 10 each 1 lakh. So this capital has to be returned to them. Then they have given the information that the dividend on preference shares are in arrears for 2 years. Okay. How do we calculate? For 1 year the dividend will be 6% on 1 lakh, which comes to 6,000. So 6,000 is for 1 year. The arrears of dividend is there for 2 years. So 6,000 into 2, 12,000. So arrears of dividend will be there for 12,000. But it is stated that the arrears of preference dividend are not payable on liquidation. Means if at all company goes into liquidation, this arrears of preference dividend are not payable. And here we are going to calculate the value of share on the presumption that the company is going to liquidation. So the arrears of preference dividend here is not payable. So only their capital has to be returned to them. So we are going to deduct here 6% preference share capital 1 lakh rupees. The balance is 2,50,850, which is called net asset available for equity shareholders, 2,50,850. In the second step, we are going to calculate the intrinsic value of share by applying this formula: net asset available for equity shareholders divided by number of equity shares, 2,50,850 divided by how many equity shares you find in the share capital, 30,000. Okay, you have to divide it by number of equity shares, 30,000. You get rupees 8.36 per share. Okay, you have to write like this, rupees 8.36 per share. So this is the intrinsic value or net asset value per share. Okay, then let us take up the second question. On 31st December 2008, the balance sheet of Ramson Limited was as follows. On the asset side, we find buildings, machinery, stock and debtors. On the liability side, share capital 5,000 shares of rupees 100 each, profit and loss account, bank overdraft, creditors, provision for taxation and proposed dividend. Here in this case, we do not have preference share capital, so only equity share capital is there. Then in the paragraph it is given the net profits of the company for the last 5 years were as under. They have given the profits for 2004, 2005, this must be 2005, okay, not 6. 2000, sorry, 2005, 2006, 2007 and 2008. On 31st December 2008, that is the current year, buildings were valued at 2,50,000, machinery at 1,50,000. Reasonable return on tangible capital is 10%. Ascertain the intrinsic value of share after valuation of goodwill based on 4 years purchase of annual super profits. Okay, so this is the main difference we find in this question. It is stated that here we have to calculate the intrinsic value of share after valuation of goodwill based on purchase 4 years purchase of annual super profit. So in this case, before we calculate the intrinsic value under two steps, we have to provide for working note, and in the working note we are going to calculate the value of goodwill, which is based on the second method, that is super profit method. Okay, so you have seen in the second chapter, that is valuation of goodwill, how do we value the goodwill under super profit method. There are 6 steps. In the first step we calculate capital employed in the business at the end of the year. Then in the second step we calculate what is the average capital employed by deducting half of the current year's operating profit. And then in the third step we calculate what is the normal return Normal return is calculated at normal rate of return on the average capital employed. Then we calculate what is the adjusted average annual profit. Fifth step, we calculate what is the super profit, and in the sixth step we calculate what is the value of goodwill. So all these 6 steps have to be followed here to calculate the value of goodwill. So let us complete the working note, then let us discuss about the calculation of intrinsic value. Now, in the first step, as we are going to calculate the capital employed in the business, please remember the format which we followed in the second chapter while calculating the goodwill under super profit method. So here we have to consider all tangible asset except fictitious asset, except intangible asset, and the non-trading investment. So if you see the asset side, they have given building, and again here also if the present value is available, you have to write the present value. If the present value is not available, then you have to take the book value. So coming to building, they have given present value, how much? 2,50,000. Machinery also they have given present value 1,50,000. Stock as it is we have to write, and data also we have to write as it is. Okay, from these 4 assets at their present value, we are going to deduct the external liabilities. Okay, liabilities to outsiders, both short term and long term. First they have given equity share capital, it's not a liability. Profit and loss account, no. Bank overdraft, yes. Creditors is a liability. Provision for taxation is a current liability. Proposed dividend is a current liability. So let us see how to calculate the capital employed. In the first step, we are going to calculate capital employed in the business at the end of the year. Building at present value, machinery at present value, stock and data, we are considering that book value itself as the present value. We get the total of 9,05,000 less external liabilities, bank overdraft, creditors, provision for taxation and dividend. We get difference of 6,88,000, which is called capital employed in the business at the end of the year. Then in the second step, we are going to calculate the average capital employed. Average capital employed is equal to capital employed in the business at the end of the year minus half of the current year's operating profit, which is the current year given in the question here. Let's see. It is 31st December 2008, and what is the profit for 2008? 95,000. If you check the asset side, there are no investments which are made in government securities or the securities of other joint stock companies. So whatever 95,000 is given in the question, it's all operating profit. Okay, so we have to deduct half of 95,000 from 6,88,000. So we get here 6,40,500 as the average capital employed. And then in the step 3, we are going to calculate what is the normal return. So it is average capital employed into normal rate of return. Here in this question it is given that it is 10%. Normal rate of return is 10%. So we get 64,050 as the normal rate of return. Then we are going to calculate what is adjusted average annual profit. In this question they have not given adjustment for abnormal losses or non-operating or non-recurring expenses or income, nothing like that. So what we are going to do, we are going to take the profit, total profit for 5 years, and then divide it by 5. We get adjusted average annual profit of 93,200. Then in the fifth step, we are going to calculate the super profit. Super profit is equal to adjusted average annual profit minus normal return. 93,200 minus 64,050. We get 29,150. Then in the sixth step, calculation of value of goodwill. Super profit into number of years of purchase, 29,150, and it should be taken at 4 years purchase. So when we are multiplying 4, we get 1,16,600 as the value of goodwill, which is based on 4 years purchase of the annual super profit. So this is just the working note to calculate the value of goodwill to be included in the intrinsic value. Now the main calculation is to value the share on the basis of intrinsic value. So the first step is we are going to calculate the net asset available for equity shareholders. Okay, here as usual we are going to write the present values of various assets, just like how we considered in the capital employed, same way. Buildings we have to consider machinery, stock, data, but along with these 4 assets we have to also write the goodwill as calculated, 1,16,600. So we get the gross market value to be 10,21,600. From this we are going to deduct the various liabilities: bank overdraft, creditors, provision for taxation and proposed dividend. So we get the balance as 8,04,600. In this case, as I said, there is no preferential capital, so whatever the balance available here, this itself is considered as net asset available for equity shareholders. And in the second step, calculation of intrinsic value of share, 8,04,600 divided by number of shares. How many? Let's see that. So here how many shares are there? 5,000 shares. So you have to multiply it by, sorry, not multiply, you have to divide it by 5,000. So it will be 160.92 per share. So intrinsic value in this case is rupees 160.92 per share. So these are the solution for the two questions which we have considered in this session. So let us solve few more questions in the upcoming videos. Thank you for watching.